Something is quietly happening in the stock market. Not on the surface, the headlines still say record highs. But underneath the numbers, three warning signals are flashing in unison. And if history means anything, most Americans are going to regret ignoring them. Let's talk about what's actually happening. And more importantly, what you can do right now. The first signal is the CAPE ratio. The cyclically adjusted price-to-earnings ratio measures how expensive the stock market is relative to average earnings over the last 10 years. Right now, the CAPE ratio is sitting above 35. That number has only been this high twice in modern history. In 1929, right before the Great Depression. And in 1999 and 2000, right before the dot-com collapse that wiped out 50% of the S&P 500 over 2.5 years. What does a CAPE above 35 mean in real terms? Research by Nobel laureate Robert Shiller shows that when the CAPE is this elevated, the average real return for investors over the next 10 years is negative 3%. Not 3% less than expected. Negative. You lose ground, adjusted for inflation, for a decade. The market is priced for perfection in a world that is anything but perfect. The second signal is margin debt. American investors have borrowed record amounts of money to buy stocks. When the market goes up, margin debt amplifies your gains. When the market goes down, margin debt turns into a catastrophe. Here's why. When stocks fall and your account value drops below a certain threshold, your broker sends you a margin call, a demand to deposit more cash immediately, or they sell your positions for you. Automatically. At whatever price the market is at that moment. When millions of investors get margin calls at the same time, they all have to sell at the same time. This creates a feedback loop. Selling drives prices lower, which triggers more margin calls, which forces more selling. It's a self-reinforcing collapse. In the 2000 crash, margin debt peaked right before the market broke. In 2008, same pattern. And margin debt today is at levels that have historically preceded major corrections. The third signal is concentration. The S&P 500 is supposed to represent 500 companies. But right now, just 10 stocks account for over 35% of the entire index's value. If you own an S&P 500 index fund, you are not diversified, you're heavily concentrated in a handful of AI and technology companies. This isn't new. It happened in 1999 with Cisco, Intel, and Microsoft. When the dot-com bubble burst, those companies lost 70%, 80%, 90% of their value. And because they dominated the index, everyone who owned the index got crushed. History doesn't repeat perfectly. But it rhymes loudly. Here's the critical point. These signals do not tell you the market will crash next week or next month. Markets can stay overvalued for years. But they do tell you this: the risk-to-reward ratio for passive investors sitting in all index, all stocks portfolios is historically bad right now. And that means it's time to make 3 concrete moves. Move 1, diversify internationally. American stocks make up about 60% of global market capitalization but trade at much higher valuations than international markets. European, Japanese, and emerging market stocks are trading at CAPE ratios of 15 to 20, roughly half of US levels. You don't have to abandon US stocks. But shifting 20 to 30% of your equity exposure internationally reduces your concentration risk significantly. Move 2, add defensive sectors. Utilities, consumer staples, and healthcare perform significantly better than the broad market during downturns because people still pay their electric bills and buy groceries when stocks are crashing. These sectors also tend to pay solid dividends, income that doesn't disappear when prices fall. Move 3, enforce position sizing. No single stock should represent more than 5% of your portfolio. This sounds simple, but millions of Americans have 30%, 40%, even 50% of their net worth tied up in one company's stock, often their employer. If that stock drops 70%, your financial life changes dramatically. Diversification is not a hedge against upside. It's protection against catastrophe. None of this is fear-mongering. It's risk management. The stock market has made Americans wealthy for generations, and it will continue to do so over the long run. But the long run only works for people who survive the short-term crashes without being forced to sell at the bottom. The signals are flashing. The question is whether you're paying attention. Subscribe to Finance Alert Global for weekly alerts on the economic trends that matter before they hit your wallet.